What if? What if I handed you the Millionaire's Playbook filled with step-by-step, easy-to-read instructions that anyone can follow? Well, today is that day. We are opening the pages of one of the best investing books of all time, revealing the strategies that have turned ordinary individuals into financial geniuses. Future millionaires, your journey starts today. Meet Benjamin Graham and David L. Dodd, famously known for their unique ability to find and buy undervalued stocks. Their legacy echoes in today's convoluted world of finance, with icons like Warren Buffett, who has become one of the wealthiest individuals globally, attributing his success to the teachings of Benjamin Graham and this infamous book. Their teachings emphasize on patience, discipline, and the art of understanding, so strap yourself in as we plunge deep into the extraordinary teachings of these financial superheroes and their magnum opus, Security Analysis. Chapter 1. Otherwise known as the decoder ring for value investing. This is where our journey begins, in the intricate labyrinth of value investing. The first step to understanding this world is to comprehend its fundamental principle, buying stocks for less than their intrinsic value. Imagine being able to purchase a diamond for the price of a rhinestone. That's value investing in a nutshell. Now you might be wondering, what is this intrinsic value we speak of? It's the true, the real, the should-be value of a company, calculated by analyzing everything from its assets to earnings projections. This isn't a quick glance at the latest stock price, it's an in-depth examination of a company's financial health. And here's the kicker. The market doesn't always price things accurately. Sometimes it's overly pessimistic, pricing stocks lower than their intrinsic value. This is where the concept of margin of safety comes into play. It's the difference between the intrinsic value and the market price. The bigger this gap, the lesser the risk. It's like having a safety net when you're walking a financial tightrope. Market efficiency, or rather inefficiency, is another key player in our value investing drama. It's the idea that the market doesn't always reflect the true value of a stock. It's the shadowy figure in the corner, the one that value investors are always watching. But remember, value investing isn't a get-rich-quick scheme. It's more of a slow and steady wins-the-race kind of strategy. It requires patience, discipline, and a willingness to go against the crowd. That's Chapter 1, the blueprint to becoming a value investor. Now let's crank up the complexity a notch. Chapter 2, where we trade our paintbrushes for calculators. Now, if you thought investing was all about gut feelings and hunches, well, it's time to think again. It's not about luck or chance, it's about analysis, and not just any analysis, but security analysis. Imagine you're a detective, and your mission is to investigate a company's financial health. You're looking at the company's balance sheet, income statement, and cash flow statement. These are your clues. They're like a company's medical records, telling you whether it's financially fit, or if it's on the brink of financial ruin. And like a good detective, you don't just look at the numbers. You also consider qualitative factors. Is the company's management competent and trustworthy? Does the company have a competitive advantage in its industry? Is the industry itself growing, or is it in decline? But how do you make sense of all this information? That's where the art of security analysis comes in. It's a methodical process, a way of making sense of the numbers and the qualitative factors. You're not just looking at a company's current financial health, but also its potential for future growth. You're looking for the hidden value, the potential that others may have overlooked. And it's not just about finding potential investments, it's also about avoiding bad ones. If a company's financial health is poor, or if its management is untrustworthy, then it's probably not a good investment. Even if the price is low, it's not a bargain if the company is in decline. So, what do you do with all this information? You use it to make informed investment decisions. You're not just buying stocks or bonds, you're buying a piece of a business. And like any business owner, you want to know what you're getting into. Chapter 2, where we replace art with cold, hard numbers. But remember, numbers only tell half the story. Because the other half, well, that's where the real art comes in. Chapters 3 to 5, where we dive into the deep end of the investment pool. Let's kickstart with bonds. Think of bonds as the mature, sensible older sibling in the investment family. They're debt securities, meaning you're lending money to an entity, be it a corporation or a government. In return, you receive periodic interest payments, and the return of the principal amount when the bond matures. Sounds pretty straightforward, right? But here's the kicker. Bonds carry both credit risk and interest rate risk. If the issuer fails to pay, there's your credit risk. And if interest rates skyrocket, the price of your bond plummets. That's interest rate risk. moving on to preferred stocks. These are a bit like the middle child, trying to blend the best of both worlds. Preferred stockholders have a higher claim on the company's earnings and assets than common stockholders. They receive dividends before common stockholders and have a fixed dividend rate, but they usually don't have voting rights. And like bonds, preferred stocks also face credit risk. If the company goes belly up, preferred stockholders are behind bondholders in the queue for any leftover assets. Finally, we come to the unpredictable, exciting youngest sibling, common stocks. Owning common stock means you own a piece of the company. You get to vote on corporate matters, and you might receive dividends. But here's the catch. Common stocks come with higher risk. If the company tanks, common stockholders are last in line to claim any remaining assets. But with great risk comes the potential for great reward. If the company flourishes, so does your investment. So, how do you analyze these securities? With bonds, you look at the creditworthiness of the issuer and the interest rate environment. For preferred stocks, you'd examine the company's ability to pay dividends and its growth prospects. And with common stocks, you'd analyze the company's financial health, its competitive position, and the overall market conditions. But here's the golden nugget of advice from Graham and Dodd. Don't put all your eggs in one basket. Diversify. Spread your investments across different types of securities in different sectors. That way, if one investment goes south, you've got others to cushion the blow. And that's the trifecta of investment securities. But remember, it's not about picking the best one, it's about picking the right one for you. The final chapters where we put all the pieces together. As we venture into the concluding parts of security analysis, our journey becomes more profound and enlightening. The final chapters of this book, penned by the brilliant minds of Benjamin Graham and David L. Dodd, delve deeper into the intricate strategies of security analysis and investing. The first element we encounter in these closing chapters is portfolio management. Now, what's a portfolio? Picture it as a colorful basket of investments, each unique, each contributing to the overall health of your financial status. The art of portfolio management lies in maintaining a balance. Not too many high-risk stocks that could potentially topple the cart, but also not too many low-risk ones that could stunt your growth. It's all about moderation, my friends. Then we move on to risk management. It's crucial to remember that investing, like any other game, comes with its fair share of risks. The key to winning this game is not by avoiding risks, but by managing them. Graham and Dodd advocate for a balanced approach, a mix of both aggressive and defensive investing. It's all about knowing when to hold them and when to fold them. Next on the agenda is market psychology. Now, this is where it gets interesting. The market is not just a collection of numbers and charts, it's a living, breathing entity, swayed by the moods and sentiments of its participants. The authors urge investors to understand this psychology, to read between the lines of panic selling and irrational exuberance. Remember, the market is often wrong, and as contrarian investors, it's our job to capitalize on these mistakes. And finally, we come across the concept of margin of safety. This principle, according to Graham and Dodd, is the secret sauce of successful investing. It's the buffer that protects your investments from unforeseen market downturns. It's the safety net that catches you when your investments take a tumble. The final chapters of security analysis are a treasure trove of knowledge. They offer a deep dive into the strategies and principles that have shaped the world of investing. They give us a glimpse into the minds of two of the greatest investors of all time. But remember, reading this book is just the first step. The true test of a value investor lies in the application of these principles. It's about taking these lessons to heart and applying them in the real world. It's about being patient, staying disciplined, and sticking to your guns even when the market is against you. And with that, we've solved the puzzle of security analysis. But remember, the true test of a value investor lies in the application of these principles. So, what can we take away from this Wall Street Bible? Here's the deal. Benjamin Graham and David L. Dodd in their book Security Analysis have given us a timeless blueprint for value investing. It's not just about crunching numbers or finding the next hot stock. It's about a methodical, disciplined approach to investing that focuses on intrinsic value and long-term growth. The book emphasizes the importance of security analysis, which is essentially the process of examining and evaluating a company's financials to understand its true worth. It's not about speculation or guessing. It's about delving into the company's balance sheets, income statements, and cash flow statements. It's about understanding the company's operations, its competitive position, and its future prospects. And it's about determining whether the company's securities are priced attractively relative to their intrinsic value. Graham and Dodd also shed light on the different types of securities: bonds, preferred stocks, and common stocks. Each of these securities has its own characteristics and risks, and they should be evaluated differently. Bonds, for instance, are considered safer investments as they promise fixed income. Preferred stocks, on the other hand, offer a fixed dividend but also come with the potential for capital appreciation. Common stocks are riskier but offer the highest potential for growth. But here's the kicker. The book doesn't just provide theoretical knowledge, it gives us practical tools and techniques to apply these concepts in real-life investing. It teaches us how to analyze financial statements, how to calculate intrinsic value, and how to make rational investment decisions. It also warns us about the common pitfalls in investing and how to avoid them. So in essence, Security Analysis is not just a book, it's a comprehensive guide to value investing. It equips us with the knowledge and skills to navigate the complex world of investing. It helps us understand the importance of patience, discipline, and independent thinking in investing. And it reminds us that investing is not about getting rich quick, it's about building wealth slowly but surely. But let's not forget, even with all this knowledge and these tools, investing is not a sure thing. It's not a get-rich-quick scheme. It's a long-term game that requires patience, discipline, and a clear understanding of one's financial goals and risk tolerance. It also requires continuous learning and adaptation, as the world of investing is constantly evolving. And there you have it, a crash course in security analysis. But remember, as Benjamin Graham once said, investing isn't about beating others at their game, it's about controlling yourself at your own game.